Hey, everyone. Welcome to Chapter 15 Financial Management in your HOR 273 class. This comes directly from the NASCLA textbook that you are using. So go ahead and read the chapter prior to watching the lecture. We're on our home stretch. We're in the final few weeks of the semester. So keep up the good work and let's finish strong. And what a perfect topic to be discussing the first week in April. We have taxes that are due here very, very shortly, here in a matter of 11 days. I'm actually recording this on Easter Sunday, 2021, and taxes are due April 15th. I know we do have an extension because of the COVID situation. So I will probably, take advantage of that as well. But let's go ahead and get started with our objectives. We're going to talk about bookkeeping. We're going to talk about the accounting cycle, methods of accounting, whether you're going to use cash or accrual method. We'll talk about contract accounting, cash management, equipment records and accounting, accounting process for materials, payroll accounting, and technology solutions for accounting. And I'm going to go ahead and be honest with you. When it comes to payroll, we have eliminated that burden from our plate. We have turned it over to a payroll service. Yes, it does cost us, but that is a cost of doing business. But what it does is save me tremendous amounts of time doing a payroll. I'm in charge of doing that. So I'm in charge of the new hire process for our landscape company. So when someone comes on board, all I got to do is get them uploaded to the ADP payroll website, and they are automatically in. So you got to use this technology and these services available for you when you are running your business. Because if you're working in the field, it's hard getting all the paperwork done. It is. And so bookkeeping, the first step in the accounting process is bookkeeping. Here are a few tips. So listen to them, kind of jot them down, think about it, and think about how you are going to run your business if you are going the self-employment route. Unfortunately, I've seen very few of our graduates do that. I can think of two right offhand that are self-employed. Most people get jobs with, botanical gardens, other landscape companies, or they continue on with their education. So, being an entrepreneur, a business owner is a very rewarding lifestyle, but it is also a lifestyle that you have to be dedicated to because there is no 9 to 5. It's 5 to 9. And I don't know if you listen to my radio show or my podcast. Um, Stanley the Dirt Monkey Genedex, one of my great friends. I love him to death, and he's on the show every so often. And we always discuss that. Being an entrepreneur is not 9 to 5, meaning 9 a.m. to 5 p.m. It's 5 a.m. to 9 p.m. every day. You're going to be working, those 16, 17, 18-hour days. It's just the way it is. It's just the way it is. But the first step in the accounting process is your bookkeeping. On a separate business checking account, you've got to have that first and foremost. Get a business credit card. You got to keep all of your finances separate. Now, the one good thing about being an entrepreneur is that, expenses like fuel, you can fill your spouse's, truck or car up with gas, and use the business debit card. You can. It's hard for the IRS to distinguish that. When it's talking about personal finances, you need to make sure that you're not paying your mortgage out of your business checking account, or that you're not paying your personal credit card out of your business checking account. The things that you can pay out of your business checking account would be like, internet at your home because you're working from home. A lot of you will have a home office. You can deduct part of your house as a tax expense. So there are some good things about that. And, you would want to speak with your attorney or definitely your CPA or accountant about that. But keep track of all your deductible expenses. Keep every receipt. There's apps that you can get on your phone, your iPad, to actually take a picture of it and actually help you sort that out. Keep all receipts and identify the source of all receipts so you can separate business from personal receipts and taxable from non-taxable income. Update business records daily to have quick access to the daily financial position of how your business is doing at that moment in time. And that's the one thing I love about a restaurant. You see that because we we eat out a lot being entrepreneurs because we don't have time to cook at home, and we're going to the restaurants just before they close, and you can see them start shutting down for the day, and you'll see the owner or the shift manager, they're compiling all of their sales for the day, and they're closing out their books for the day. That's the way landscape contractors and green industry pros really need to do it. If you could see exactly what you made or lost that day, it's a good way to keep up with your expenses and your income. Accurately record all information in the checkbook ledger. I'm guilty of not doing that and having to catch up, at the end of the month. Record expenses when they occur so you have an accurate picture of your cash situation, and avoid paying with cash so you have that paper trail of your expenditures. I always use a card. I never have cash to begin with. I even have to go to the vending machine and swipe my card to get a soda out. It's just I very seldom have cash. Balance your checking account monthly, probably needs to happen daily, and then keep all financial records for the required amount of time as designated by the IRS. And typically you're going to keep records for 7 years. The accounting cycle. Step 1, classify and record transactions. Daily transactions are recorded in a set of books called journals. Typical journals include cash receipts and sales journals, used when cash comes in or a sale is charged to a customer. You just sold a job. You just sold a landscape design to a customer or a mowing visit. Purchase journal tracks all purchases made by the company, and then cash disbursements journal used when cash is paid out. And then the payroll journal used to record a summary of payroll details such as salaries, wages, deductions, and employer contributions. Payroll service does that for me. So all I've got to do is log into our account, and I can print off that journal very, very easily. And then general journal used for non-cash transactions. The accounting cycle. Step 2, post transactions. Posting is a process of transferring the transactions recorded in the journals to the appropriate accounts. An account is a register of value. Most companies use 5 basic types of accounts. Asset, that means you own something. That would be like your equipment. You've bought a new skid steer. That is an asset to you. The loan on that skid steer is going to be a liability. So you still owe money on it. You have to pay that. Your workers' comp, your insurance is a liability. You have to pay that. Equity. All right, let's say you've purchased that skid steer for $30,000 and you've paid it down to $10,000. You've got equity in that skid steer. Income. You're selling jobs to customers. You're able to bring in that income. That income is used to pay down those assets and to pay those liabilities and help increase your equity. And then you have an expense, which is payroll, fuel, plants that you're buying for jobs that you're going to install. All of that is considered an expense, but 5 basic types of accounts. Step 3, prepare the trial balance. The trial balance is a total of all the ledger accounts. And then step 4, prepare adjusted trial balance. There are 6 general types of adjusting entries: a prepaid expense, accrued revenue, unearned revenue, estimated items, and inventory adjustments. So check out your textbook about that. Prepaid expense, that's basically telling you that you've prepaid for it. Basically, we're prepaying for our workers' comp and general liability. Accrued expense, it happens over time. Accrued revenue, you're working, you're getting that money. Unearned revenue, you've actually sold some jobs. That can, look good on paper. Hey, we've sold $100,000 worth of jobs. We just haven't started them yet. Your estimated items, and then inventory adjustment. You're always adjusting your inventory. But a lot of the times, the green industry, we have very few items to worry about with inventory. unless we are a design build contractor and we're purchasing all these materials and actually doing it. When it comes to turf grass and lawn maintenance and stuff, there's very few inventory items that we're keeping other than our fertilizer and our pesticides. Step 5 is prepare the financial statements. The 3 basic types of financial statement companies use are the balance sheet. Accountant always wants to see that. RS wants to see that. Gives the owner a good insight into the growth and stability of a company. It is your assets that equals your liabilities plus your owner's equity. So it's telling you how much, where you're sitting at with the stuff that you own, your assets. Your income statement, a summary of the company's revenues and expenses over a given period of time. Income is the cost of goods sold. Well, income minus the cost of goods sold is your gross profit. And then your gross profit minus your expenses is your net income. And I do believe that is a quiz question, ladies and gentlemen. So pay attention to that. And then the statement of cash flows summarizes your current position, your cash resources, and the use of these funds over a given period of time. And then notes to financial statements, relevant information with no specific place within the financial statement, accounting policies and procedures, and your current and deferred income, taxes, pension plans, retirement program costs. So basically stuff that, you're liable for, for your employees or whatever. And, the taxes that you will owe at the end of the year. Step 6, analyze your financial statements using financial ratios. Your liquidity ratio is your current assets divided by your current liabilities, is equivalent to your liquidity or your current ratio. Quick ratio is your current assets minus inventory divided by current liabilities is your quick ratio. Activity ratio, revenue divided by days in the business year. Is your sales per day. Current receivables divided by sales per day is your average collection period. Your debt ratio is your total debt divided by total assets. And then your profitability ratio is your net income divided by revenues. And then return on total assets ratio is your net profit after taxes divided by your total assets. Methods of accounting, cash method. This is reports income in the year you receive it and deduct the expenses in the year you paid them. Accrual method is recognize income when the services occur, not when you collected the money. Changing your method of accounting. Once you have set up your accounting method and file your first tax return, you must get IRS approval before you can change to another method. And so I talked to my accountant about this, especially in our home building business, because we not only run Elite Landscape Contractors, Inc., full service design build landscape contractors. We run Tier 1 Structures, a custom home building company. And we build, we're on our second home for the year. So we're not a big home builder, but we do it. We got our general contractor's license to actually help us in our landscape contracting business to actually bid on some of the higher end jobs. And so we decided to actually, build some houses as well. But I asked our accountant, I was like, which method should we use? He wanted us to do the accrual method. And I went against his knowledge. And I think I'm okay for that. I mean, I really do. But I can see where it would benefit him. And let's take a look at this. And let's just take the house, for instance. If I am to build a house and I start it in November, November 1st, well, it takes 6 months to build a house. So I'm going to have 2 months in 1 year and 4 months in another year. With the accrual method, I'm going to be able to take all income expenses related to that house and pay the tax on it when I sell it. Cash method, let's say the homeowner gives me a substantial down payment of $50,000. Well, that's income. And we're only able to get in the foundation and part of the first floor system, which I got a draw for. So I got income for that. And let's say it was $25,000. So I've encountered $75,000 worth of income. And let's say I've only had $25,000 of expenses. I got to pay tax on that $50,000 in that year. I can't transfer it over and keep it with the house. So being a home builder, yes, accrual method should work a lot better. But we chose the cash method just because at one time we had so much going on. And at that moment in time, it was beneficial to us. But I could really see where accrual method would work for individuals that are doing 3 or 4 major projects a year, and it's lapping years. It's going, starting, late fall, going into early spring or something, while you may want to have the accrual method. But again, you would want to meet with your CPA or tax attorney and determine that. Most construction businesses use 2 tax accounting methods, one for their long-term contracts and one overall method for everything else. The choice of your contract accounting method depends on the type of contracts you have, your contract's completion status at the end of your tax year, and then your average annual gross receipts. So again, this is something you would want to discuss with your attorney. Your completed contract method: income or losses reported in the year that the contract is completed. Disadvantage of the completed contract method are the books and records do not show clear information on operations. True. Income can be bunched into a year when a lot of jobs are completed, and then the losses on the contracts are not deductible until the contracts are completed. So it's kind of, you're doing the taxes on it when you finish the job. You're able to get that income and loss reported that year that the contract is finished. So I kind of would work the same way with home building as well. Percentage of completion method recognizes income as it is earned during the construction project. Cost comparison method is an approach that combines the completed contract and percentage of completion methods. Your percentage of completion times your contract amount is your cumulative earnings, and then your cumulative earnings minus the amount billed today is your billing overage and deficiency. Your cash management, cash flow. 2 important aspects of maintaining a positive cash flow are collecting accounts receivable and billing and collecting for current projects. As an entrepreneur, you get behind on this. You do. It's hard to come home at 7, 8 o'clock at night if you're running your business from your home, eat dinner, spend time with the family, and then sit down at the computer and start invoicing. You got to have a software system. You got to have QuickBooks. You got to have it implemented with either LMN software or Jobber, Service Autopilot Pro, whatever type of software that you want to use. You need to have it to help you mainstream it and to streamline your cash flow. Because guys, let me tell you something. You can run on 2 years with negative cash flow, and that means you're borrowing from Peter to pay Paul. And at the end of 2 years, it comes to a screeching halt. You can do it. You can run on negative cash flow for 2 years. That's what my accountant said. And trust me, I've seen it happen. I've seen it happen. At the end of the 2 years, you are flat broke. You have not one dime left to pay anything. So make sure you manage your cash flow. Cash management. Collecting accounts receivable. Correspondent should look professional with the services rendered and the amount due clearly displayed on the invoice. That's why you need to have, a type of software system helping you do that. I can't stand individuals that handwrite their invoices and estimates on a 3-carbon copy form. It drives me absolutely crazy. And we use a lot of subcontractors that still do that. And I'm like, hey, email me an invoice. Well, you know what they do? They still handwrite the thing and they take a picture of it and email it to me from their phone. I'm like, God almighty. It just drives me crazy, the unprofessionalism that's out there. But follow-up invoices should be sent on a regular schedule. This will convey that you're serious about receiving prompt payment. If the account falls delinquent for more than 3 months, a stern letter outlining the consequences for non-payment should accompany your follow-up invoices. If you're having problems collecting on accounts receivable, you may want to hire a professional collection agency, and they're going to take a big percentage of it, usually probably half. But what it does is show your customers that you mean business. Billing and collecting for current project. Prompt billing for current projects is important to receiving timely payments. You have to bill every day. You do. You need to be on top of it. Once you receive the approval or partial or final payment, you should immediately send an invoice requesting payment. And then the payment should clearly outline payment terms. Bad debts. If you notice the amount of accounts receivable is increasing, you may need to adjust collection procedures. Payments with progress payments, partial payments made after specified phases of construction are complete. So basically, you're getting a draw on a large project. Now, if you're working for a commercial builder, forget it. It's not going to happen. You're not going to get draws. You might on a residential builder, but commercial contractors, it's outlined in the contract when they will pay you, and that is 30 to 60 to 90 days, depending on their payment application process before you're going to get paid. Payment for lump sum contracts calculated by the percentage of work completed, payment for unit price contracts based on the actual work units completed, and then payment for cost plus contracts based on actual cost rather than a percentage of completed work. Your final payment should include the final payment amount plus any retainages owed. Your final payment, that's your final draw. You're closing out the books on a particular project. You're finished with it. Payments, North Carolina prompt pay law. Prime contractor payment must be made within 45 days after completion of the project. Like I said, it's going to go longer. It really is. And you're going to sign lien waivers and everything else to extend it. So do not get into commercial landscape contracting, working for commercial builders, unless you have, a stash of cash to help you get through the 90-day period to get paid. Project delays. If the project is delayed by the fault of the contractor, the project may be occupied without payment or interest past the 45-day limit. Interest, if final payment is delayed past the 45 days, the prime contractors do 1% interest per month on the unpaid balance. Subcontractor payments to subcontractors by the prime contractor must be made within 7 days of periodic or final payment of receipt. You got 7 days to pay your subs. Subcontractor retainage for subs cannot exceed the retainage percentage withheld from the prime contractors. So let's say you're working for a commercial builder and you are the landscape contractor and you sub out the irrigation. You can't hold retainage on that. You can't hold 15% retainage if the commercial builder is holding 10% on you. You can only hold 10% back. So you got to be fair when dealing with it. That's why I just do everything in-house. Guidelines for payment of subcontractor payments. Payment to subcontractors by the contractor must be made within the 7 days of receiving a periodic or final payment. But hey, what if the prime doesn't gotten paid yet? That happens a lot as well. Interest begins on the 8th day. 1% interest per month on the unpaid balance is due. And then grounds for withholding payment: unsatisfactory job progress, defective construction not remediated, disputed work, third-party claims filed, or reasonable evidence that a claim will be filed, failure of the subcontractor to make timely payments for labor, equipment, materials, damage to the contractor or any other sub, and reasonable amount of retainage not to exceed the initial percentage retained by the owner. Petty cash fund, small payments made without writing a check. It is important to document these expenditures should be balanced and replenished monthly. So if you want to take out $500 from your business checking account, put it in the petty cash fund. You just got to keep up with those receipts and stuff like that. Usually your CPA is not going to sweat it, if it's 20, 30 bucks here and there. But if you start withdrawing, thousands of dollars each month for petty cash, they're going to want you to write checks. Equipment records and accounting. For accounting purposes, information on equipment must be tracked. Important information to record includes the use rate, the use time, your maintenance cost, repair cost, and operating cost. You need to know this seriously for your equipment. How much does it cost to operate that skid steer? If you had to, get one of the tracks replaced or repaired, you should know what it is. You need to know what you're going to charge the customer per hour on the job site using that machine. How long does it take you to do certain things? You should be able to load a dump truck in X amount of time. You should know all of this stuff. And that way, when you're keeping up with your equipment records, it's not so hard to do. Depreciation method: the process of devaluing a fixed asset as a result of aging, wear and tear, or obsolete. You're going to have depreciation. You're not going to be able to deduct everything on that machine every year. Straight line depreciation: initial asset cost minus the salvage cost is your depreciation cost. Depreciation cost divided by the useful life years is your yearly depreciation amount. Accelerated depreciation, this asset is depreciated at a higher rate during the early part of its useful life, permitting larger tax deductions. And so a lot of times people would depreciate a piece of equipment like over 4 or 5 years. Your modified accelerated cost recovery system, your MARCs or MACRs, allows for faster depreciation over longer periods. Shipping and delivery expenses, you got to pay FOB freight, allowed and prepaid, and your payment terms depend on the payment agreement between the buyer and the seller. The process for preparing payroll. Get ADP software to do it for you guys. I think we pay them $60 to write our checks a week. So we're spending $240 a month. But that's a big headache off my back. It's another hat that I don't have to wear. And it's cheaper for me to pay them to actually hire somebody in the office to do that. But this process for preparing payroll is you calculate the gross pay for each employee, calculate and deduct applicable taxes and other deductions, calculate net pay and issue checks, and then update the payroll journal. Calculating gross pay determined by a salary that you set for the employee or based on an hourly wage multiplied by the number of hours worked. And then calculate and deduct applicable taxes and deductions, your Social Security tax, your Medicare, your advanced earned income credit, state income, and then any other inductions or deductions that your employees may have. Calculate net pay and issue checks. Gross pay minus taxes and deductions is your net pay. Update your payroll journal once checks are issued. Now, the one thing that I like about ADP, let's say you have some employees that may have to have, child support deducted or whatever. They take care of all of that. What if people are behind on their federal student loans and it's being garnished from their paychecks? ADP handles all that. I don't want to hold anybody's money and send it somewhere else. That's why we use the payroll service. Technology solutions for accounting. There are many accounting software programs on the market that can help the accounting process easier. QuickBooks is one. Accounting software can automate the process of posting transactions, creating financial statements, invoicing customers, creating purchase orders, and much more. So when choosing the right software, consider what your needs are and how the technology can grow within your company. So anyway, guys, I appreciate it. This is Financial Management, and I'll see you in the next lecture.